We have a great program today, and I'm really excited about it. Actually, one of our clients, well, two of our clients came here today to talk to you about the very beginning stages of planning for a transition of their business. But before we do that, I just want to welcome everybody to the Greater Los Angeles Exit Planning Institute chapter meeting. My name's Melissa Silverman. I think I always forget to say that to everybody. I founded and am the chapter president of this group. I think we started it in like 2016. So we've been going through for a long time now. And I want to just talk about really quickly the mission of this chapter. The mission of the Greater Los Angeles Exit Planning Institute chapter is to be a premier organization for education, collaboration, thought leadership, and deal flow for advisors and business owners who are either working in the business transition advisory space or who are going through a transition of their business. So we have, I do want to let everybody know a couple things. First of all, we are recording this session. As you know, we record all of our sessions so that we're able to send it out in case you weren't able to stay for the whole time, or in case you came late, or in case you weren't able to attend. This way you're able to listen to the recording. The other thing I want to make everybody aware of before we get started is that we're going to be doing, as we always do, we're going to be doing the instant meetups at 4 p.m. when we end. So those who are in the room, you will have a chance to network with everybody in the room. And those who are on Zoom, we will have a chance to network with each other. So if you cannot stay, and I really hope that you can stay, please let Melissa Smith or myself know in the chat so that we can plan for the rooms for the meetup, the networking after the meeting. Okay, we have a great, as I said, we have a great program for you today. Before we get started with this, I wanted to let everybody know, we started the year with a case study. The Cooper family case study that everybody should have read by now. We've sent it out a number of times, and we're going to be using that fact pattern in 4 meetings. As a matter of fact, next month's meeting, we will be doing small group case study work, and we will be using that fact pattern. But I'm mentioning it today because inside of that fact pattern, there is a whole bunch of information of things that the company has done, hasn't done, things that they should be thinking about, and all of that. And the reason it's so important is what we're going to discuss with the clients here today is the very beginning steps of planning for the exit or transition of a business. And so as we have this discussion today, think about how it relates to the Cooper family and things that maybe they didn't do that they should have done, or things that they could have done but just didn't know to do. So I just want you to be thinking about that, because every month we want to make sure that we keep bringing the Cooper family case study back up, and that you're thinking about how that could relate to the planning as well. And that'll help us for the next meeting where we're actually going to use that case study, and we're going to do a program around it. Okay, so I want to also mention, if anybody's on Zoom and you're actually in LA, as you can see, we have a room full of people there. We want to encourage everybody in LA to attend the meetings. If you're not in LA, then you are more than welcome to attend via Zoom. And we want you to attend via Zoom. So for instance, I'm not in LA today. I'm actually in Nashville, Tennessee. And my partner, Jeffrey Case up there, wave Jeff, he's actually in New Jersey. So if you're not in LA, we still want you to attend and you can attend via Zoom. So please know that this is for everybody. Okay, I am actually going to turn it over to my partner. He doesn't even know this. So my partner, Jeff Cates, and we both work at the Founders Group. And Jeff, I'm gonna have you introduce the clients that are here today. And then Jeff is going to kick off the program. And we're going to have a very short PowerPoint, and then we're going to get into a discussion with the clients, and we're going to do a role play for you to show you how this can go with a client. So I hope that you're going to really enjoy the program today. So Jeff, it's all yours.
Thank you, Melissa. And also, just so you know, also on Zoom are our clients and good friends, Adam Berryman and Lloyd Biggs. They're down in San Diego. Adam and Lloyd, thank you for being here for everybody. What I'm going to do, I guess at the start, is I'm going to just set up this PowerPoint here and share my screen. So let me go ahead and do that, and we'll go from there. Okay. And I'm going to set up the slideshow. Fabulous. Okay, so I'm going to introduce Adam and Lloyd to you. Adam and Lloyd are co-owners of a budget blinds franchise in Southern California, specifically in the North County of San Diego. They got to us because they were contemplating an eventual business transition at the time. And I'm going to have them talk a little bit about that in a minute. The company is growing, it's profitable. For the most part, Adam focuses on sales and ensuring margins are strong and dealing with operations. And Lloyd focuses a lot on the finance side and also with operations. Lloyd and Adam, why don't you each take a couple of minutes and just kind of introduce yourselves, and if you could just talk to everybody about how you kind of got to us and what was on your mind when you were thinking about, you know, as you were thinking about it, how you kicked off this process and kind of how you got to us, and then we'll go from there.
In this case, we'll let beauty go before age. Adam, over to you.
Yeah, I'm Adam Berryman. You know, obviously Lloyd and I are business partners. We're formerly next door neighbors, and you know, we really kind of got together over beers, and that's how we got into business together. You know, simply said. And you know, we've been franchise owners now for what is it, 7.5 years? Yep. And we have a great business, and you know, I'll let Lloyd kind of talk a little more into how we got to the Founders Group, but I mean, ultimately, we were having good conversations around the future of our business, and we'd read some books, and you know, we figured that, you know, we needed to take a partner in that, and so, you know, we did some research and ended up with the Founders Group. It's a lot of roads pointing back to the Founders Group, and that's how we got there. Lloyd?
That's all right. So, okay.
Sorry. Yeah. So, as you can see, there's quite a age difference between Adam and I. I'm, I think, right on the nose, 20 years older than Adam. As he mentioned, we were next door neighbors drinking beer on the weekends. I love you, man. And then decided to, you know, go into business together. So, found the franchise Budget Blinds, purchased 2 territories to begin with, and then we started marching down the road and acquired a couple of more, and then just a couple of years ago we acquired our 5th territory. So we have a nice center of gravity in San Diego, you know, for our Budget Blinds territories, 5 territories, which were one of the largest in the Budget Blinds system. And just to pat ourselves on the back a little bit, we were Franchise of the Year last year. So we've just really drank the Kool-Aid, you know, from a franchise and Budget Blinds perspective. But as Adam mentioned, you know, this is 2021 timeframe now, maybe 2020. We started having discussions about, hey, okay, things are going great, but this is becoming a pretty big deal, and we need to, what's going to happen down the road. At the time, Adam, his wife was on a track to retire in about 5 years from now, and his plan at the time was to, once his wife retired, pack up the family and move back to Nashville, Tennessee, where he's from, that area of the country. So we thought, okay, well, we have 5 years, there's plenty of time, and so speaking of the book, which introduced us to EPI, was this book here by Mark Tepper. Many of you are probably familiar with it, but Adam found this in an airport bookstore on one of his travels, and he just picked it up, and it's an easy read. He's able to read it pretty much on his plane ride home. And he came home and he said, hey, holy crap, you need to read this book. We got a little work to do. And then, so I got the book and I read it, and I broke out into a cold sweat and thinking, oh yeah, we got some work to do. So long story short, we got introduced to, because Mark in his book talks about Exit Planning Institute, hit their website, found the founders group down here in San Diego. They seem to be a good fit, from a locality and also personality perspective as we talk to them. So we just then started, the process of working with the founders group, and I guess the rest of the story will unfold as we talk about today.
Thanks, guys. That's great. Appreciate it. And I want everybody to remember. So as Lloyd talked about, Adam's wife on a 5-year track. Let's put our heads back 2 years when we first got together as we uncover this as part of the process, because I think that fact is pretty important, and it'll come up again as we talk today. So real quickly, for us, the discovery process that we took Adam and Lloyd through consists of a comprehensive business valuation. And then, of course, we do some assessments. We do a personal and financial assessment. And then we also do a business attractiveness assessment and a business readiness assessment. Once we're done doing all that, our deliverables to the client include a complete valuation report. Each owner gets their own individual personal and financial assessment report, which is confidential to each owner, whether or not they choose to share them with each other. Oh, you pulled it up? That's great, Adam. That's great. I'm glad you still have it. It's not a coaster. So they each get their own personal report. Whether or not they choose to share it is up to them. But those personal reports are handled individually because each owner may have some nuances and some differences that they may or may not want to share. So we keep that separate. And then the business attractiveness and readiness assessments are combined into one report. And then we tie it to an executive summary, which links the valuation that is determined through that valuation, as well as the results of the assessment. And from there, what we're looking to do is develop, okay, well, what kind of action plan do we look at? Are there areas and gaps that need to be remediated and improved? So that's essentially the process as we look to do value creation along the way.
Jeff, let me jump in here for a minute.
Yeah.
So as many of you know, the Exit Planning Institute has a value acceleration methodology. And they have 3 gates. They have the discover gate, they have the preparation gate, and then the decision gate. What we're talking about here is exactly what is in their discover gate. Okay, so they do the valuation and all of the assessments, and that's what we're talking about here. What I do want to just mention to everybody is what's different about what we're talking about here than what everybody learns about at EPI is when we do a valuation, it's not, it is a calculated valuation so that we're able to show a client, here is the range of value for your business right now. And if you make some of the improvements that we're going to identify from these assessments, you could increase the value of your business, and we're going to show another range of where that business could get to, which I think is really important for a business owner to understand. The other thing I just want to mention about these assessments when EPI talks about the assessments, it's typically an assessment that you do with a business owner, and the business owner will answer some questions and then they get their results. We do things a little bit different because we want to be able to really provide value for a client. So in these assessments that you're going to learn about and see role played here today, not only does the business owners individually or separately, I should say, answer all the questions, but we also, because we are consultants that are already analyzing the business through doing the valuation, and we're analyzing the business for other reasons, we independently take these assessments and we're showing them, here are our scores, and our scores differ from you, and here are the reasons why. And so I think that that's very important that a business owner receive this, because it gives them some objective, independent information that is not just self-relying on, here's what I think. You have somebody else that's independently saying, I think the same thing. I think your business is doing really well, or I don't think your business is doing well, and here are some of the reasons why. And that's what all of these assessments are doing, is providing them with validation or providing them with the justifications for why their business may not be doing as they think it is.
Or better than they think. That happens too sometimes, right, Melissa?
Yes, it does.
Yep. Thank you. Thank you very much for that, for explaining that as well. Okay, so as I mentioned, the personal financial assessments are done confidentially with each business owner separately. We also do the attractiveness and readiness assessments individually with each business owner. And the reason for that is we're trying to triangulate responses, see where the business owners agree, see where they differ. It kind of helps us hone in on potential issues amongst the business owners, or to identify areas of the business that we maybe need to take a closer look at. So we do each of those assessments separately, and it's done on purpose. But we do combine it into one report, so then the business owners can come together and see each other's scores and where they thought, so they can have some pretty healthy discussions, which, as Adam and Lloyd can attest to, didn't take for the reports to come out. I'm sure those conversations happened as we were doing those assessments. Broken down, it's about 100 questions, give or take, in the business attractiveness and readiness combined. The readiness is more for a particular reason. So we look at these assessments, and let's say that the business is shown to be an attractive business and it looks good to an independent potential acquirer. That's great. That's the first hurdle. But even if it's attractive, that doesn't mean the business is ready to be transitioned. That's totally separate. And so we get into the readiness with a little more detail, as Adam and Lloyd can attest to, and really dive into where is the business today and what are some of the opportunities or gaps and areas that can be looked upon to create value and get the business ready and be proactive to any potential offers that come in. And as Melissa said, we do our own independent assessment and we compare those results against what the business owners came up with. There are 4 categories of questions that we ask for both assessments, and those categories are business factors, financial factors, market factors, and then owner considerations. What are the owners thinking about? The way we do these questions is we have it's like taking a survey online, and there's algorithms behind everything, but really we ask the business owners to answer the question from a strongly disagree, and then it goes somewhat disagree, neutral, somewhat agree, to strongly agree. And we ask them to rank themselves for that question where they fall. And behind the scenes, we have some algorithms going to come up with some scores. Now, I think you'll see this in the role play today, but one of the most critical things about these assessments is not necessarily what the owners and how they respond. and we'll talk about it a little more. It's really the conversations that happen, the follow-up questions, and the digging a little bit deeper and peeling the onion back a little bit. And okay, hang on, we're talking about this, and Lloyd, you mentioned this, but what about, let's go here. And through those conversations, there really is a period of where as consultants, we start to get to really understand the business, because it's very hard to be a good advisor and partner to a business owner if you don't really understand their business almost as well as they do. So this discovery process is really meant to be an educational process, not just for the business owners, but certainly for us as well, so that we can have very intelligent conversations. And of course, the goal of these assessments, as Melissa mentioned from this Discover Gate, is to identify gaps and areas for value creation, and to get the business ready, and just to help improve the value of the business along the way.
I want to mention a couple things. In addition to what Jeff is saying, in addition to it being an educational session for us to learn as much as we can about the business, which we truly do, because we are all about getting at that last 10% of information that a business owner never wants to share with us. But this is also the business owner's chance to get to know you and to see the value that you can start to bring to them, and to make a decision as to whether they want to continue working with you or not. And that is just as important as everything else. If you don't bond with the client, if they don't feel that you understand them, they're not going to continue to work with you. So it's just as much they're vetting you as you're trying to learn as much about the business as you can. The other thing I want to mention here, I should have mentioned this earlier. If anybody on Zoom has a question, please put it in the chat and we'll get to them. And then we're going to open it up for people in the room as well. So if you have any questions, just hold on to them or make a note and we'll open it up. But we did get a question that I just want to answer, because I've gotten it from a couple different people. The question is, what is the source for the 100 questions? Is it from EPI, third-party software, or did you develop it internally? And I just want to answer that question by saying, we did start by using some of the software vendors that EPI does. What? Oh,
Yeah, that they recommend.
that they recommended.
That was way back.
We did start with that. We used it for about a year. And what we found is it was not doing for us what we wanted it to do. And so we ended up developing our own set of questions, and we've revised them a number of times. And we've taken it from being a tool that we used in Excel to now we have an online survey tool that we use for our assessments. So for everybody out there who's doing this, it's a trial and error process. You have to figure out what works best for you and how you want to develop your assessments for that.
And I can tell you, we spent hundreds of man hours and significant dollars to develop our tools and reports that are now, I would say, third generation. They've been iterative along the way. And this has been over the years. To Melissa's point, we started with one of the vendors that EPI recommends, and for us, it just wasn't getting to where we needed to, and so we decided, we made that commitment to develop our own questions. Okay, let's get through this, because I want to get started with some of the role play. But what the next couple of slides are just kind of some sample questions that we're not going to get to today, but I did think it was important that you kind of get an idea for some of the types of questions that, as we're sitting with the business owners, we're going through. So for instance, in the business factors, we ask questions like, the company's brand alone strongly and effectively attracts new customers. And, the business owners will answer that on that scale. And then we'll talk about branding and marketing, and we'll get into it, and it'll lead to some more questions. The company's business systems are very effective and very reliable. We really want to understand about the company's infrastructure and their technology. So these are just some of the questions that we're going through as part of the business factors, because we're trying to assess how attractive this business is to an outside investor. Some of the financial questions maybe we would ask is, I'm very satisfied with the net income generated by the company over the past 3 years. And that leads to a conversation about performance and numbers and profitability. Same with the balance sheet. We're trying to get an idea of the cash and how strong the balance sheet is. We're going to get into some questions about the market that the company is in. Are they actively pursuing new markets? The industry that they're in is strong and growing or not. As far as owner considerations go, some sample questions. I have a strong conviction that I should sell, transition the business. And then another great one we always ask is, I'm confident I understand all of my internal and external transition options. And we, Adam and Lloyd, we may talk about that, because that certainly was one of the questions that I know was an eye opener for you as you guys did this. So I'm not going to.
Jeff, I just want to stop you here for a moment, because I want to let everybody know Jeff is going through these questions so fast right now.
Yeah.
But I have to tell you, when we do this with a client, and I'm sure Lloyd and Adam are going to be able to testify to this, we get so deep in these questions. These questions are not asked as fast as he's going through these questions right now. We really dive in and we ask the client, and they are the ones who talk. We don't do a lot of the talking. It's about the client answering these questions and sharing, giving us their input.
Yeah, and I would
Lloyd,
say,
Adam, would you guys agree with that?
you're on mute, Adam.
I think we went over every Zoom call that we had scheduled. Not that that's uncommon with you, Jeff, but it definitely happened on these calls. It was,
right. And the reason is because we start with a question and then the conversation starts, and there's stuff to hone in on in those conversations. So you just don't know where it's going to lead, but it is our one great chance to really get into understanding the business and what some of the issues are and getting clarification. So yeah, it definitely does sometimes run over. We always try and balance the owner's time constraints versus the knowledge capture.
And the other thing is that all of the follow-up questions and the conversation that you end up having with the client, that's where all the substantive information is. It's not in the first question that you're asking them. It's in the conversation that ensues.
Yeah.
So if I'll just add, every one of the questions, it's as if you're talking about your child, right? So we would maybe spend 10 minutes on a particular question, and we enjoyed, it was really enjoyable to talk about each of these questions and really start to think about them. And there were a lot of aha moments in midstream in the conversations for each one of these questions. So it was a lot of fun. It was a lot of work and a lot of time, but it was a lot of fun too.
Thank you. So for everybody on the thing, I'm going to move past the sample questions. As Melissa mentioned, if you want to see them, they'll be, they're in the PowerPoint that'll be distributed. So I'm going to stop sharing, and what we're going to do now is, I think this is a great time to transition. What we're going to do is,
Jeff, before you go into the role play, Yelena, I want to just open it up because we've taken some questions from people on Zoom. Does anybody in the room have any questions about what we've talked about yet, or should we continue on?
Wasn't there a question about how we charge for our services, how we charge for this?
Yeah, I said we'll get to that. I didn't want to go over that right now. Yelena, is there any questions anybody has in the room? Okay, I don't see any. So let's go ahead and keep going. Go ahead, Jeff.
Okay.
Correct.
I'm sorry, what?
I was just confirming there are no questions in the room.
Oh, okay. All right, go ahead, Jeff. Let's continue.
All right. So, Ursula, I've got a list of about 12 questions or 15 questions. I don't think we're going to get through them all. The purpose of this is to just kind of see the interaction of the business owners and us as we work through some of these questions and what the process looks like. Remember that we did this 2 years ago, so we may slip up. We've instructed Adam and Lloyd to try and remember where they were at 2 years ago and what it looked like when we first started, as opposed to the fact that we're 2 years later and we've been working together on some value improvements. And so things have changed. But as they mentioned, it was back in the middle of 2021, I would say, that we got together. And even when we got together, Adam and Lloyd knew of a couple of issues, so that they knew they needed to deal with at the outset, and they were very forthcoming about it. So hopefully we'll get into it a little bit now. So we're going to start the role play. The one other thing I want to mention is the way we do it at the Founders Group is there's always two of us in the room, because we have one person leading the questions and responses and the back and forth, and then the other person is always taking notes. We're taking copious notes to include in the report and to follow up, and so there's it would be best if there's more than one person in these sessions as you take notes.
And just to include, and Adam and Lloyd, you're going to hear this, you probably didn't know this before, but the notes that the other person is taking is not just notes about what the people are saying. It's notes about body language. It's notes about, was there a pause? Was there a long pause? Did they really not know? Were they stumbling with their answers? So there's a lot of different things that as you're doing this, that you want to make sure that you're paying attention to, because the business owner is giving you a lot of information. It's not just verbal. There's a lot of nonverbal cues that you want to make sure you pick up on as well.
Yeah, that's a very good point. Did you see Lloyd's eyes get all big there? Oh, wow. See, there you go. And there's another nonverbal cue.
And they didn't know we were doing that.
All right. So now remember, this will be a little disjointed because normally we go through a session, but we just wanted to kind of give you a broad scope. So Adam, let's talk a little bit about the management team at the company. Do you feel, I'm going to read you this statement, and I'd like you to assess this from strongly disagree to strongly agree. The management team is strong enough to operate effectively without me, and the management team would be very impressive to an investor.
Disagree.
Okay. Can you elaborate a little bit? Tell me a little bit why you disagree with that statement.
Well, we really are pretty involved as the owners at this point, and we've made, I've had a lot of conversation about putting the management team in process or into the structure of the business, but we haven't quite pulled the trigger yet. So
Adam, I guess the first question to ask is, who do you consider to be on the management team? At what level do who do you include? Is it just you and Lloyd, or are there others?
So we had a sales manager at that point. Yeah. So we had a sales manager and then Lloyd and myself and Lloyd's wife, Angela participated at kind of at that level also with some of the other things we had going on as the office manager, right, at that point. So yeah, but no general manager. We don't have any structure like that. So it was a lot of generally Lloyd and I.
So what happens if you're on vacation, Adam? How does the business run while you're away?
It runs fair, but it's always a little nerve-wracking, because if something goes sideways and we're neither one of us is there, it's a little scary.
Okay, thank you. Now, Adam wouldn't have been in the room Lloyd wouldn't have been in the room for this. So now I'm going to go to Lloyd. Lloyd, I'm going to read you the statement. Please, rate this question from strongly disagree to strongly agree. The management team is strong enough to operate effectively without me, and the team would be very impressive to an outside investor.
Strongly disagree.
Okay, you want to elaborate a little bit? Tell me why.
Sure. We don't. We are involved day to day in the business. So just from an outside investor looking in, they don't want to come in and buy this and then buy themselves a day job. So this would not be attractive at all for an outside investor. And we don't have if we want to go on vacation, we have gone on vacation at times where we had to stagger our time to make sure that we minimize the amount of time that both of us are away from the office. So, you know, we don't have, we feel like the office can run okay for a few days while we're not there. But, you know, we can't be away for a couple of weeks and feel and enjoy that couple of weeks and, you know, feel strongly confident that the office, you know, that the business will continue to operate.
So have you thought about a potential solution for that? Have you guys sat and talked about what that could look like to take care of that situation?
Yeah, after reading Mark Tepper's book, you know, and they talked about having that management team in place. So it's a bit of a bit more of a turnkey operation that someone might buy, since we're talking about, you know, exiting the business at some point. Absolutely. Those are the kinds of things that we need to start thinking about. I'm not sure that we're there yet. I'm not sure that we could afford to hire someone to bring them in and take over the day-to-day operations that Adam and I are in charge of. But certainly we need to start thinking about it and maybe planning for it sooner rather than later.
Okay. All right, great. Let's move on, Lloyd. The next question I want to ask is, the company's business systems are very effective and very reliable. How would you rate that question?
I think I'd somewhat agree to that, but I'd be shading towards neutral on that one. But let's call it somewhat agree.
Okay, so talk to me a bit. So what systems do you use for the company? Like, do you have an inventory system? Do you have a CRM system? Tell me a little bit about your systems.
Yeah, well, the rock solid systems we have, obviously, QuickBooks. We use QuickBooks Online. We like the online version versus desktop, despite the protestations of our bookkeeper, who's a, you know, old school book, you know, desktop QuickBooks desktop guy. But
yeah.
So, you know, and we Microsoft Office and Microsoft Exchange, so the email systems, the communication systems, all that's great. We do have a CRM. We don't really carry inventory, so we really need an inventory management system, but we do rely heavily on a CRM system. And our franchisor, Home Franchise Concepts, has developed a system called Touchpoint. And it's a, you know, the concept of it is great. It's lead management, customer management, order management, order submission, tracking. It's basically the cradle to grave, if you will, of CRMs. But because it was custom developed by the franchisor, who's not a software development company, it's got lots of what we call in the Marine Corps sucking chest wounds for of gaps of capability. So that's where I start getting into the somewhat agree or neutral, because it doesn't do everything we need it to do, and we end up closing the gaps between our CRM system and our financial system, for example, with desktop procedures and spreadsheets and, you know, air gapping data between systems. So it's not a great situation.
So Touchpoint doesn't connect to QuickBooks?
Well, it does, but
does.
it does it poorly. I mean, badly. And in fact, you know, they've turned it off sometimes here and again, because it's just, you know, it just doesn't work very well.
All right, we'll maybe have to come and spend a little more time revisiting that when we do the readiness assessment.
Yeah,
Talk about
that is one of the things that we know is a big gap for us and something we'd like to work with you on.
Yeah, that's great. Adam, same question.
I'd say neutral.
Okay. Do you have anything to add to what to what Lloyd was saying? How does it work for you out in the field and with your sales team?
It's great out in the field. So it's a great tool. I mean, it's where it's best, really, is out in the field. It's where, you know, the office parts and processes that, you know, it's really painful to have to live off multiple systems when you know that there are definitely companies where one system encompasses all.
Okay. Next question. This is for Adam. We'll start with Adam. I have a strong understanding.
Jeff, sorry, I want to stop you. I was on mute. I want to stop you for a moment. I just want to explain to everybody at this point, what you need to understand is that we do these assessments with one business owner at a time.
Right.
So the conversation that you just heard with Lloyd and with Adam, neither one of them would have heard the other person's response. They're hearing it here for the first time. but they did not hear it when we did it with them. And the reason that that's very important is because when these assessments are being done, part of what you're looking for is, are the business owners in alignment? Are they on the same page as far as how things are running, how the business is doing? Or are they on different wavelengths? Are they going in different directions? Are they not in alignment? These are all things that as you're doing this, you should be trying to identify and looking for those gaps. So I just wanted to make that you all aware of that as Jeff's doing this.
Yeah, Melissa, we'll do just a couple more questions because then I think we got to talk about the valuation and then we want to get into the other questions for them. So I'm just going to
We got time, Jeff.
Okay, I'm going to pick a couple of meaty ones. So Adam, can you rate this question, please? I have a strong understanding of the current value of my business.
Yeah, neutral.
That's about what you did 2 years ago, by the way.
Yeah.
And do you have any idea on what you think that number is? Do you have a number in your head?
Yeah. I mean, after reading the book and trying to, going through, because we've made our couple acquisitions and stuff. So we've talked generally about, how valuations are done. So we have a general idea. Yes. But we're definitely not experts at it.
Okay, well, as you know, that's part of what we're gonna be doing here. So hopefully in 30 days, 45 days, we'll come back and we'll compare what you thought versus what value we come up with. Lloyd, I'll ask you the same question. You have a strong understanding of the current value of the business.
I would say, again, somewhat agree, shading towards neutral, but we'll stick with somewhat agree. In the way we bought the business in the first place, we worked with a business broker and they used the SDE multiple, methodology for the purchase. And we didn't have any outside help. We just we Googled some things, obviously, and we're both spreadsheet fanatics. So we did our own, valuation, if you will, but just based on SDE, added in some of the owner thing. And then, the current multiple at the time was 2.6. So that's the multiple we use. And that's what I think we know what the valuation of our business is today.
So I'm going to break character at this point for everybody on this session. So at this time, we had asked the Adam and Lloyd to give us what their number was, and they provided it to us. And when we did the valuation and came back, the number that came back was almost double what Lloyd thought. Adam was a little closer, certainly, I would say, closer, but still a little lower. But for Lloyd, it was an absolute eye opener. Would you agree with that, Lloyd? And do you want to talk about that for a second?
Yeah. I mean, again, spreadsheet magic, add-ins, owner discretionary earnings stuff, and then multiply that by 2.6. I came up with that number, and looked at also looking at our current P&L. So we went through this process, and when they gave us the number, it's like, oh wow, okay. So and obviously there's a lot more that goes into a business valuation than just the P&L and the the SDE multiple, but that's what we knew. So it was eye-opening.
All right, I'm going to ask one or two more questions, a couple more questions, and then we'll move on. There was one other owner consideration question I wanted to ask because I think we need to talk about, and that is, so I'll ask Lloyd first. Over what time frame would any potential sale or transition occur?
Is that a strongly agree?
No, that was a time one where we had, it was 0 to 1 year, 1 to 3 years, 3 to 5, or greater than 5 type of thing.
It was, I think, 2 years ago, it was 5+ years. So, but like right around 5 years, it was like imminent.
Right, and that was the conversation, right? That it was right. And Adam, what about you for that question?
Yeah, I mean, I think we kind of knew that we were on the 5-year timeline, at least generally, that we were I think we're a lot tied to my wife and, her retiring at some point and maybe not actually wanting to be here anymore.
Yeah, and then that next question that we ask is do you understand all of your exit, options, both internal and external? And we ask that question, and uh, we look for that strongly agree or disagree. And can you talk a little bit about where your heads were at the time when we first started, about what you thought your exit options were and where your minds were at? Especially the interplay of the two of you and from an age perspective and where you were at. I think that's really fascinating for everybody to kind of hear that conversation of where you started versus where you are.
Adam.
Yeah, I mean, so, we were, I'm younger, obviously, so it was I really kind of wanted to continue on, because I have a lot more time to go and continue to invest in things. And so I didn't really have a lot of urgency to sell, even kind of with my wife retiring. And I thought that, we had kind of had some off the cuff conversations about maybe me buying out Lloyd at some point, or selling the whole thing, just depending on the situation and what the valuation was and all that, tax implications, timing, all that stuff.
Yeah. And what about you, Lloyd? Where was your head at the time, if you remember?
Yeah, so I was looking forward to 5 years from now, and in the way we were running our business at the time, I didn't feel like I wanted to be Johnny on the spot, with Adam in Nashville and me being here from a day-to-day operations perspective. I'd be 63 and felt like at that moment, and I'd already had a career in the Marine Corps and almost a whole other career in defense contracting. So this is really my third big gig. And, I just was looking forward that 5-year time horizon, and, just didn't want to do it on a day-to-day basis without Adam here. So I was more strongly focused on, well, we need to figure out something. And, and it felt like our only option at the time was, let's do as much as we can do, and then, sell it, shake hands, and, be lifelong friends, and then move on. And Adam continue on with his entrepreneurial, pathways, and me kind of selling into retirement and enjoying, retirement kinds of things.
Okay. Remember this, because we're going to talk a little bit more about this after the role play kind of, and we'll get into it. So everybody, some of the questions that we've just asked were just a tip of the iceberg on the attractiveness. We haven't even gotten into the readiness yet. So we're going to transfer now and put on our caps of, okay, the business is either attractive or it isn't, but now let's see how ready it is. So I'm going to ask just a couple of quick questions that I want to focus on that were, in my opinion, were some pretty big issues for Adam and Lloyd as we got into it. So let's ask the first question. Let's start with Adam. Adam, if you could rate this question: the owners receive and review monthly financial statements.
Strongly disagree.
Okay. So what's going on there? Tell me about it. Tell me about that. Why do you strongly disagree?
Well, our bookkeeper is 100. No, really, we outgrew our bookkeeper up to this point, and it's just really hard to feed him everything, get him kept up to the point where we get P&Ls. It's definitely an initiative. It's definitely one of the reasons we're talking right now, is because we do want to have that at some point. But
Adam, help me understand. You kind of know where your revenues are at and where your cash is at. So what's going on here?
Yeah,
I'm trying to understand what's going on.
We have magic spreadsheets that we put together every month, and we are pretty good and we're pretty spot on. But it sure would be nice to have P&Ls that just come in from somebody that we can review every month.
Lloyd, I'm going to ask you the same question.
Somewhat agree. And here's a good example of like the big disconnect. So I was running the financials, and we can talk about if we at some point, a little bit what the big problems were with that. But from an income perspective, we weren't feeding QuickBooks in a way it needed to be fed at that time. When we started off, we were small. It was, our books were in great shape, but as we grew, we had a hard time keeping up. We were depending on that CRM system. But on the expense side, the expense side was rock solid. We were bringing in expenses, categorizing them, no problem. So what we were doing basically was running the QuickBooks P&L, and then I was just grabbing the last month's revenue, which was spot on, and sticking it in, modifying the spreadsheet of the P&L and sticking it in at the top line. So from my perspective, even though it was a little bit of a manual workaround, I feel like we did have pretty strong, I'm talking present tense as of 2 years. I feel like we do have pretty strong grip on our monthly P&Ls. We just have to do a little manual tweak to the, the spreadsheet downloaded out of QuickBooks to see what that, that P&L is.
Gentlemen, let's see if this conversation rings a bell. Adam, Lloyd, it's September 2021. I'm looking at your financials in QuickBooks and your revenue shows $0. How are we going to get a valuation done?
I'll give you my master log.
Right.
We just take sales up to this point, we put it in the spreadsheet,
So everybody, we just hit on like one of the major initiatives that we had to do with Adam and Lloyd was how could we even get a valuation done? The valuation ended up getting delayed by about 2 or 3 months while Adam and Lloyd's bookkeeper got the data in for 2020 and into 2021 into QuickBooks, that we had a set of books that we could rely upon to do the valuation. And obviously,
and I just want to jump in here for a moment, because like Jeff is saying, they're trying to sit here and tell us that everything was good, but we had the financials, and we had the financials that showed 0. And so we knew that we could not go forward because there were things that were going on that weren't being shared with us. So this is where you have to dig and you have to dive deep to really find out what's going on and why things are the way they are.
I characterize that a little bit different. We weren't not sharing with you, but the data just wasn't available.
correct.
In the
Yep.
way that a banker or an investment firm or a professional accountant
Or a
would
tax
want to see
preparer.
it. Yeah, or a tax preparer, exactly.
I agree with you, Lloyd, completely. All I'm saying is that in general, you don't know what your clients are really, if they're trying to hide something, they
Yep.
don't want you to know. They're trying to keep it from you. We've had clients that it took almost a year to get the right information from them, the right financial information, because every time they provided it to us, it wasn't the information that we could use. So that tells us a lot about how that business is being run.
Yeah, and I will say, to Adam and Lloyd's credit, everybody, this was well known by them coming in. So this wasn't a shock to us because they expressed this. What it did do was highlighted the fact that we had to jump a step a little bit. Normally, in the discover phase, we're trying to figure everything out, and then we move into that value acceleration phase. Well, what happened here for us is we clearly saw that we could help Adam and Lloyd get up to speed. So we almost put the cart before the horse here by engaging and doing some work, and we helped Adam and Lloyd get their books up to speed, which we'll talk about a little bit later. But we almost put the cart before the horse here. We had to help them out. It became very clear with regards to this specific issue. And there were not a lot of issues in this company, I have to tell you. So don't think that this was not a great company. It's just this was something that needed to be dealt with.
Hey, Gil has a question about balance sheet.
Yeah, let me just see that question.
So the question is, how is the balance sheet formulated with your hybrid system?
So my response to that is, what good is a balance sheet? So that's where our head was. We know what the P&L is, we know what our profit is. So there were some knowledge gaps there at the time, and we're still working through them. I mean, neither one of us are accountants, and I still don't really. I understand the components of a balance sheet, but to your question, Gil, we did not have a good balance sheet at all because it was incomplete. It didn't have all the information it needed.
But there were some interesting conversations that came up because of that. If you remember, Adam and Lloyd, right? We talked a little bit about the cash reserves. This company was remember, we were coming out of COVID, And there was a lot of money flowing around in the economy, and a lot of money had been provided to these businesses, to small businesses. So there was PPP money and there was an EIDL loan. So the balance sheet was very flush. And some of the conversations we had at that time was, don't be fooled by the strength of your balance sheet. Don't be fooled by all that cash. You know, Adam and Lloyd, I'm going to remind you about one of the conversations we had about the EIDL loan. When we first got together, what the thing was, so are you making payments yet? Was a simple question I asked. And they went, what? And I'm like, hey, interest started compounding the moment you took that money. And Lloyd's response was, well, maybe we'll start making some payments on that. Right? Like, so there's interesting things that come up out of this discovery session that come about that affect operations and affect everything that sometimes there are blind spots to.
Right.
But yes, to answer your question, there was a balance sheet. The only thing that was a little, the accounts payable were fine, the cash was fine. It was really just the accounts receivable piece of it. Yeah. So then just to finish off, I think, you know what, Melissa, why don't we end there? That's enough of a role play, I think, for everybody. I think you should spend a minute or two and talk about the valuation process.
So the valuation process was pretty straightforward once we were able to receive financials that actually showed that there was income, because we knew that they were generating income. It just didn't reflect it. So once we were able to get all the information, then we were able to go forward and develop the analysis and come up with the value for the business. And again, as we talked about, we didn't come up with there are different types of valuations that can be done. You can have a certified valuation, which is really where you're providing a conclusion of value. In this case, for exit planning, we generally do a calculated valuation where we provide the client with a range of value. And the reason for that is because, especially when you're just getting started, and in this situation, Lloyd and Adam, I don't think you've ever had a business valuation done, have you, at that point? So for a lot of companies, if they've never had a business valuation done, we think it's important, and as they're either trying to grow their business or if they're trying to plan for the transition of the business, we think it's important to show them what that range of value that they're in right now is, and be able to show them, here are some of the value drivers, these are the strengths of your business, and then here are some of the risk factors in your business, and these are the weaknesses. These are the things that have to be improved upon. And so we were able to do that and provide them with that range of value for them to see, so that they could start to see where were some of the areas that they needed to work on and improve upon as they were going through this process.
Yeah, great. And remember, we tied that valuation to the assessments and provided a report to Adam and Lloyd, and we spoke about it, about what it meant and how we tied some of those value improvements that were identified, including, there was a big piece, we didn't really talk about it today, there was a piece about hiring a general manager. And there was obviously this piece about improving the financial reporting, which, Lloyd, how long did it take to as we worked on that financial reporting? Well, you know what? Yeah. How long did it take for that initiative to come to fruition? And, tell a little bit about where you're at now with all that.
Yeah, it was the better part of a year. Just briefly, our CRM system has all of our sales data in it. And during COVID, we had an internal bookkeeper, young lady, who would just put the numbers in QuickBooks. We gave her, she wanted a layoff. We didn't lose her, like she just wanted a layoff, but we lost her during COVID. So I took back over the books, but we had grown so much to the point by that point that I wasn't able to keep up with the books. So then I was like, oh, well, I'm a spreadsheet guy. So I started trying to figure out a crafty way of downloading all the sales data out of our CRM system, and then using a system called SaaS Ant to upload them into QuickBooks, which then, like, why am I even doing this? I've got all the sales data in my CRM. So I'm just going to do journal entries for our revenue every month. Well, what I ended up doing was breaking the deposit reconciliation process on the back end. And it took us pretty much the better part of a year to get out from underneath all of that and get back to just a normal, process, hiring an external firm to basically just do all this bookkeeping and all the daily, data crunching, number crunching for us.
So Adam and
it
Lloyd,
was a year.
yeah, Adam and Lloyd, it's April 26th. Do you have your March statements?
Yes.
Yeah, there you go. Fabulous. So anyway,
And,
all right.
and before you go on, I just want to say to everybody, that should be one of the questions that you ask any client is how quickly do you get your financials from the previous month? Or are you getting from the previous month? Or how far back is it that you're getting your financials? When we started with them, in their case, it was a year behind. They were a year behind. And so, and we had another company that we worked with that was almost more than a year behind. So if they don't have, if they're not looking at really up-to-date financials, that right there should be telling you a lot about that company.
Yeah. We're going to switch gears now. What I'm going to do is I'm going to ask, and Lloyd, Adam, this is open to, either of you, both of you. We're going to go over some questions now. I'd love for everybody to get into your minds a little bit about the process and what you took out of it. So not just answering questions, but really, what did you take out of it? So let me just ask, for you guys, what were some of your biggest aha moments from this whole discovery process? And what were your biggest takeaways?
Adam.
Well, so
Other than I talk too much.
Oh, I mean, one of the things, the general manager conversation that sparked from that was probably one of the bigger ones. And we had kind of read it in that book about how much the general manager can add to the multiple, at least on the valuation, because somebody's a different buyer, right? You have somebody that's coming in that's buying a investment versus a job. And so, that was probably one of the biggest things for us. And it was more of a different perspective, right? Because going in, it's like, how do we afford a manager? And then now it's like, let's just make the investment up early, a little earlier, prematurely, at least in our minds, to where we're going to get that back in droves on the valuation side. And we hope that then we get more time to focus on more strategic things, which has happened. And so I think that was probably the biggest one. And then, really the conversations around everything, because we go through the process and then it's stuff that kind of just sticks and grinds. And we're going back and forth with Jeff on one of the topics, and I'm kind of making mental notes or notes. And then Lloyd and I, after he goes through the process, and then we get to partner up and start talking about both of our perspectives on things. It's like marriage counseling.
Certainly about margins, right? Are you talking about the margin conversation or some other ones, or?
Well, just any of it.
Yeah.
We would go through these, and both of us, we would still kind of come back around and talk about each other's answers, after we went through the process. So y'all might not have known that part.
Lloyd, what about you? What was some of your big aha moments or takeaways? By the way, if any of you had any personal ones and you're comfortable in sharing, because we haven't really talked about that on the personal side, some of the tax consequences of a potential deal and whether or not you were ready. So feel free to, if you want to share some of that stuff.
Yeah, I think my biggest takeaway was, for example, I just talked a little bit about the financial system, right? And I know our financials, I know what our P&L is, all that, right? And my biggest takeaway was, it doesn't matter that I know it. If we're going to sell the business, it needs to be in a shape and documented in a way that's immediately recognizable to professionals that are dealing with business transactions, right? So a generally accepted accounting principle compliant accounting system, right? The method of taking numbers out of one system and jamming them into the top of a P&L, even though it's a pretty darn accurate P&L, that's not compliant with GAAP principles, obviously. So what I had to do was get out of the, hey, this is the baby that I built or that we built, and then say, we need to get this baby in shape so that it is, again, immediately recognizable as a well. And by the way, an investment banker or whoever business broker comes in, they take a look at the books, and if they see a set of books that is, I wouldn't say pristine, but immediately like, oh yeah, okay, got it. You get that level of comfort, from those professionals taking a look at your business. So my biggest aha moment was, it doesn't matter how pretty we think our baby is, that we got to get this baby in shape though, so that it is pretty for other people who don't know our business, but will immediately recognize the value of the business.
For everybody in this meeting, that was so insightful, Lloyd, and I almost want that to echo for everybody, because not every business owner understands that, and certainly as quickly as you did. It's a huge deal. And if business owners can get to that level, it opens the door for them in a lot of ways. All right. Adam, talk a little bit about, actually, no, I want to ask this of Lloyd. Lloyd, talk a little bit about how your outlook or demeanor or thought process changed after comparing the value of the business from the valuation versus what you thought the value was prior to the start of the discovery process. Did it change your outlook at all?
Yeah, I mean, we thought we knew what our business, or I thought I knew what the business, obviously, and I was the slow swimmer in the group between Adam and I, because obviously he was closer to what the real number was. And my view of valuation was very simplistic, and, and the way we bought the business was very simplistic. And in hindsight, very lucrative in the way that we bought the business, because I don't think, probably, even though they had a business broker, they just used a simple STE method and then added back in, the leased car and the health insurance and all that, and then just did a quick multiple thing, right? So regardless of whether that business was valuated property or not, we bought it. We've now, in hindsight, bought it at a value, and our intent all along was to grow this thing and sell it. Well, in my mind, we're just going to sell it like we bought it. And after going through this process, first of all, it's much more complicated, a business valuation. So the professional valuation that we had done was eye-opening in that, oh yeah, we're going to have this done, professionally. And, maybe we ought to consider having it done professionally 2, 3, 4, 5 times in between, until we get to the point where we sell it. But then also going through this process, the levers that you can pull, push and pull and push buttons in your business to create more value, like a management team, like, document a healthy accounting system, and all these things that I didn't really understand that added value to the business other than just the bottom line. So I'm much more attuned now to the things that we've got to accomplish, at some point. And at some point, Jeff, we ought to talk about how now our timeline has changed because of personal decisions, between the two of us. And we'll talk about that. But the work still needs to be done, and at the very least, and I've talked to other franchisees now, I'm a little bit of an evangelist for exit planning within the Budget Blinds franchise community. You ought to just do this anyway, regardless of whether you understand whether you're going to sell your business or not, because at the end of the day, once you go through this process and you do everything you need to do, well, you got a really well-run business, and then if some opportunity comes up, some investor comes out of the woodwork and says, I want to give you X amount of money, and what the value of your business is, and you can understand whether that is a good deal or not, you could just take advantage at the drop of a hat versus being, if you're in a position of wanting to sell your business and now you just got to take what you can get because you didn't start except for a year out, or maybe you're just like, I want to sell my business this year. And then, you're just not going to get the value out of your business that you should.
Great. Adam, do you want to add anything, or should I just get the next question to you?
He pretty well covered it, really.
Okay, good.
Sorry, Adam.
That's fine. So Adam, I just want to know, did your mindset about transition shift at all after having gone through the discovery process? And if so, how did it shift?
Like, so it's like, can you rephrase it just a little bit?
Okay, so when you walked into, when you started the process, did you have an idea about what the transition may be? You talked about a 5-year period, and whether, you were thinking about potential options and how you're going to deal with Lloyd. did that shift at all after having gone through the process and some of the questions and conversations we had, or did you, kind of still stay on the same path?
Well, first of all, to be clear, I didn't say I needed to deal with Lloyd, but no, it's
Fair enough.
again,
I'm gonna pay for that later.
it really sparked a conversation between he and I'll just go ahead and get into this because this was kind of like the revelation is we just got deeper into our conversation about what the future of the business looks like. And I mean, there's a lot of things that kind of go into this process and the conversations about what happens when you sell and when the tax implications are always the heavy one, right? It's like, what does that end game look like, and what's your potential cash flow after that versus the cash flow that you have now at this point running the business. And as we started to have this vision with managers running the business and where we're not just in it every day, and that we can work on more strategic things and actually pick and choose the things and delegate the things we don't like doing and pick and choose the things that we really enjoy and or we feel like we're going to add the most value to. Well, then that conversation really turned into Lloyd and I leaving the office one day that we were over there meeting with you guys and we were going to lunch and we just kind of started having like a little bit more of a in-depth conversation about what the future looks like. And that turned into like, hey, I don't know that I want to maybe move to Nashville now. Like I definitely don't want to like sell the business because I don't want to deal with the tax pain because I've already been there with some other things that I've done, unless some obvious big thing happens that causes us to do that. So then he and I are talking and we kind of re-engaged at that. And, we kind of come to terms. It's like, well, we've got good cash flow. We get these managers in here and it's a little bit more self-sufficient. We can go on kind of indefinitely. Matter of fact, why don't we just keep reinvesting back and maybe even make some acquisitions and try to grow the thing? So the total mindset shift.
Lloyd, what about you? I think it would be great for everybody to hear. Maybe did you both agree in that sense? Did you have a different take on it?
Yeah, no, similar. I felt a little pressure, after reading Mark's book, and then I started working with you guys. It's a metaphor that I broke out in a cold sweat, but I was completely stressed out. So I thought, holy crap, we have so much work to do, and we got really a couple of 2-3 years to do this, because then you need a good 2-3 solid years of a track record of a solid numbers and a good accounting and all the stuff that we needed to do. And so I felt a lot of pressure. And then as Adam said, we started having that conversation, and it was really just a year ago that Adam said, hey, I'm rethinking my strategy of moving to, after Christine, his wife, retires, and moving to Nashville. And in fact, not even rethinking. He says, I'm pretty sure we're going to stay here now, which that was a lot of relief, because now we don't have this 5-year timeline where we've got to make this thing happen. But by the same token, all of the things that we had been talking about getting managers in and this and that, the tired old phrase of we wanted to be working on the business versus in the business. But truly, for us to make a lot of the progress that we need to this, we needed to extract ourselves out of the day-to-day operations of the business, so we could focus on, I could focus on revamping the accounting system, we could train a GM and do the training that we need with a management staff. I mean, we just had a meeting yesterday with our installation manager because he's not doing everything we want him to do. So, those kinds of things. So the true, and I've always heard the work on the business versus in the business, like, yeah, but we're owning that now. We are out of the day-to-day stuff. We've got a GM, we've got 3 managers, and my wife has basically taken over all of my stuff that I was doing day-to-day. So she's like the CFO, our GM's like the COO, and we're the CEOs. And we now can truly, make some progress on getting this thing to where it needs to be.
I just want to add here, Melissa, if I may, just for 1 sec, I want to add here, for everybody in the room in LA and also on the Zoom call, I just want to remind everybody, this is still the discovery process, right? That's why we're going to talk about that's why we're having this importance of the discovery process. This was all happening at the discovery phase. you know, for Melissa and I, we weren't recommending any solutions. We weren't suggesting that they go do anything of the sort. We were still just trying to uncover what everybody's truth was and what was going on. And the beauty of this discovery process, when you combine it with the valuation and all these conversations, is the business owners are having their epiphanies on their own. So it's very fluid and things change on a daily, weekly, monthly basis, but there's no pressure and there's no solution even thought of coming in yet. This is just a natural byproduct. Melissa, did you want to add something?
No, I was just going to say we only have a few minutes left, and I want to make sure we have a chance to get to some questions. But before we do, I want to just ask one last question, and it's the last one on here. Knowing what you know now, is there anything that you guys would have done differently?
Are you
Through the
talking about differently in the exit planning process or different in our business?
No, different in the process that you guys have been going through.
I would say no. I mean, we're still in it, you know, and you know, it's going to sound like a commercial, but you know, the value that we've gotten going through this, just the discovery phase, and now we've got some initiatives that we need to work on, and one of them, you know, we have engaged the founders group on as a follow-on engagement. I wouldn't do anything different regarding the process that we embarked on and the things that, you know, we're discovering and that we're working on.
Adam, how about you?
I agree. Same answer, really.
Okay. Okay, I want to open it up to any questions. I do have some questions online, but are there any questions in the room before I go to the online questions? Okay, that's a first. Okay, so one of the questions that we did get here was, do you record the sessions with the clients as you're doing this? And we do not record these sessions. It's not to say that they can't be, but remember, you're trying to get a lot of information out of clients, and you're trying to have them be as open and honest as you can. And I don't know that a client, Adam, Lloyd, would you guys be comfortable when we did this with you? Would you have been comfortable with us recording the sessions?
Remember where you were at the outset in terms of a trust level with us and as you were getting to know us too.
Well, I mean, I guess if you said, hey, like, there's a lot of information in here for us, and we don't want to miss anything, I would have been like, yeah, okay, no problem. I don't really see a problem with that, as long as it's not getting broadcast to the world.
Yeah, I mean, me neither.
Okay.
You know, I go back to my Marine Corps experience a lot. My pay was on websites and, you know, public information. So I just grew up as kind of an open book kind of guy. So yeah, whatever, if it helps people, that'd be great.
So what I will say is you have to take the clients as they come. Some clients do not want you to record them. Other clients, maybe you can. You just have to take it case by case. We had another question that came through asking whether this was a certified valuation or whether it was an automated or kind of a software that was used. For their valuation, we do certified valuations for sure, but this was a calculated valuation. It was still a comprehensive analysis of the company, but we wanted to be able to provide them with a range of value, not just a conclusion of value. We wanted them to have that high and low range so that they could use that to determine what did they want to do with it, how much of an increase, and how are they going to do that. It was not automated. This was not anywhere where you go in, you put in a few numbers, and then it spits out a valuation report. That is not what this was. This was a comprehensive analysis of the strengths and weaknesses of the business, going through all the different approaches to value. So it was comprehensive.
Hey, Adam, do you have the valuation report next to that, the assessments or no?
Let's see. I have, hold on.
It's a big report. I mean, it was, you know, it's a huge report. So
Fair equity value, membership interest, I don't, valuation, bam, this is the Bible.
Yeah.
Um, and the other question I want to just go through here is, are all of the assessments done face to face, or do you ask prospects to take the assessment online? And I think that this is a really important question, because I know that EPI talks about how you can have your clients go through and take it online. We don't do that. Now, sometimes we might do on a face-to-face assessment. We don't do that either usually. We do it on Zoom. And we always, as Jeff told you earlier, we always have 2 people there, because each person is doing something different as part of the assessment. The other thing here is, we do not have the client go through and take the assessment themselves. And we've debated back and forth on this, but the reason why is, when they go through and they take the assessment themselves, you're not getting all that additional
Yeah,
feedback.
That's
And you
the main
don't know
reason.
what their mindset was when they took that assessment. So you're losing a lot of valuable information that you need to get, and you just lost it.
The critical piece is the back and forth conversations. If business owners think of this, Adam and Lloyd, if you went in and just clicked a button and wrote some stuff down in an automated assessment, would there have been any value there? Would there have been any aha moments that happened through the back and forth conversations? What do you think?
Oh,
No.
it would have definitely not been the same. Like I would have went and just picked stuff rather quickly, you know, I mean, thoughtfully, but quickly. But there was a lot of questions where I think we had a lot of conversations like, what do you mean by this? And
Exactly, yeah.
Yeah, that because business owners, and that's a pitfall that we have to face is, for Adam and Lloyd, it's their first assessment. For us, it was what, our 30th, so, and we forget that, right? The information is second nature to us at that point. And we fall into that trap of, well, we understand what we're asking. Why don't you? And when they're seeing it for the first time, there's explanations that have to happen and clarifications. As great of wordsmiths that we think we all are, when you're in the middle of it, you may not see that there could be some potential issues with the wording of the question. And certainly when we went through it with Adam and Lloyd in our previous iteration of our model, we struggled on importance ranks and this, and that's part of the reason why, as a company, we changed what we were doing. We had to simplify the ability for the business owners to really grasp the questions and be able to answer it fluidly and quickly so that we could move on to the conversations.
Adam and Lloyd, I want to ask you a question, because it's one of the questions that we got here. For each assessment, how much time did it take to do the assessment for each one of you?
Do you remember?
Remember, I think it was like each session was a couple of hours, I think.
Yeah.
Something like that.
2 to 3
the-
hours each
Huh?
one? 2 to 3 hours?
Yeah, so the personal is about 2 hours. So each individual person has a 2-hour personal session. Then what we do is we break up the attractiveness and the readiness sessions. The attractiveness is a little shorter than the readiness. The readiness is just a painful session. Would you agree, Adam and Lloyd? It's painful, that readiness, because there's a lot more questions. It's a good 2.5 hours, I'd say. And for us, we're always weighing the time constraints versus the meat that we're getting. And we have learned that it's better to say, let's stop here, let's add another hour because this is great. We find the business owners want to talk about this and they really want to go a little more in depth. And so it would be a crime for what business owners are paying for us to shortchange them by trying to get it all in a certain amount of time. I'd rather come back to Adam and Lloyd, say, Adam, Lloyd, this stuff is great. We're getting there. We're getting so much. And I know it's not going as fast as you want. Do you mind if we add another hour on? We'll set up a time because we do need to get through this, but there's just so much here. And
Paul, okay, Jeff, Paul, we'll get to your question in just a moment. Yelena, you have a question in the room.
There's a question in the room. Go ahead.
Yeah, hi, thank you. So are there any nuances to how you draw out the aha moments for a single investor as opposed to you've got the two here?
Did you guys hear that?
yeah, I would say it doesn't really matter how many business owners there are, because remember, we're doing each of these individually anyway. It really comes down to how you're able to read the business owner to figure out, are they being forthcoming? Are they being forthcoming is one thing, but being honest with themselves. And we ask that right at the beginning, is just be honest, because the more honest you are with yourself, the better we're going to be able to triangulate what's really going on. You know, and part of the skill and the nuance is to be able to figure out, is there something deeper here? What do we have to come back to? What is not being said here, or what is being said but really is something else? So I don't think it matters if it's one owner, two owners. Sometimes it's parent and child, and those questions are different. What you ask a child versus what you're asking the parent who may be exiting and the child coming in. It's really, I would say, as much as I talk, it's really about listening and capturing some of those nuances to know when it is you got to probe a little bit and push, and when you have to take a step back and leave it alone for now.
I will also say, we had another client that was looking to sell his business, and we didn't know the business. So before we could help him with structuring a deal, we needed to get to know that business. And we spent 12 plus hours with that business owner in a very, very short time span so that we could get to know him and we could be able to help him. And we learned so much, and he learned so much. He hired another company to do the valuation of his company. And by
Prior
the
to
time
engaging us, yeah.
prior to engaging us, and by the time we got done with him, he said, you have to do the valuation for me, because there's nobody that knows my business as well as you guys do. So that's what can happen. You know, that was a very big aha moment, I think, for him, that he didn't realize that somebody, you know, working with him for 12 hours, that somebody could get to know his business as well as we were able to get to know his business. So that's why these conversations are so incredibly important. Kathy? Did you have a question?
We good? Okay. Given what appears to be a really good synergy that the four of you have developed in terms of communicating and all the work like this that you've done in the past, how do you perceive where the two of them are going is going to shape the next phase of what you do with them?
That's a really good question. If Melissa, if you don't mind, I'm going to take this just because I spend more time with Adam and Lloyd than Melissa does. You know, I'll answer this by saying this: Adam and Lloyd know that Melissa and I and the rest of the partners at the Founders Group are here for them. So, you know, Lloyd, how often do we speak, would you say?
Weekly?
Weekly. Do we have an engagement currently?
No. Well, no. Well, I mean, we just a little punctuation on the last one is what we
Right, and the other one that may be starting. But my
Right, the
point
phase
to
two.
that, right, and my point to that is, and I don't want to speak, and Adam and Lloyd, you can answer this from your perspective as well, is Adam and Lloyd know we're here, and they know we're not selling anything. We're not trying to get them to think. We're just here for them to help them prep their business and give them options for whatever it is they want to do on their timetable. And so I think the nuance is that Adam and Lloyd know that we're just here to help them, and there's no rush. They'll figure out what it is they want to do, and they know that if they need to talk about something, they pick up the phone and we'll get on and we'll talk about it and give them some thoughts, our thoughts. And they also know that for certain initiatives, they have a partner, an advisor that will look out for them. Adam and Lloyd, I think it would be helpful if you answer that from your perspective too.
Go ahead, Lloyd.
I'll use the analogy of like a doctor-patient relationship. You know, you go to the doctor and let's say you have a little bit of an uncomfortable, situation. You don't go to the doctor and then lie to the doctor about what's going on. You tell the doctor what the heck is going on so the doctor can help you remedy what ails you, right? So in coming to the founders group and, specifically Jeff and Melissa, we've invested in this. We took hard-earned money and we invested in this thing that we really believed that we needed to do. The last thing that, the worst thing that, we could do, or any owner that could do that would want to, get them these services, would be to shade the truth about, what's going on in the business, right? So, because we don't tell them everything's going on and tell them every little, hidden little corner of everything that's going on. They're hamstrung in helping us then achieve what we want to achieve. So, it was a little bit of a dance, just briefly, just getting to know them. And then it was open kimono and, off we went. So, the relationship and the trust that we have with them, it would be stupid not to, unless of course, and we never did, but unless of course you get down the path and like, these guys are, I don't think they're, whatever, I'm going down a hole a little bit, but, I just, there was never a moment once we started going down this path that, I didn't enjoy everything that we're doing. Because again, we're talking about our baby and then we're talking about making our baby prettier. It has been, and it continues to be a really great relationship.
That answer your question, by the way?
In a way, I was just kind of wondering, given what you know about the next step after discovery, and how they're beginning to perceive the business in a different way because of having a general manager and being able to do more strategic things with the business. Adam and Lloyd, do you feel like this is going now in a very different direction than you thought that it would?
Adam, you got that one, and the answer is resounding yes.
Yeah. I'll say, that I watched this thing yesterday, and I'll be brief, but like there was this spy on his YouTube video. He was a CIA spy, and he was trying to make the point of what the CIA had trained him to do in order to be like a international spy and get close to some general, right? And basically it was like, if you can get people to tell you, so there's like he named off like 3 tiers of like, like people have like 3 personas basically. It's like their work persona, their just kind of general friend, public persona, and then like the closest friend, wife, spouse, whatever persona. And if you can get deep into kind of that third persona, well, then you're in and you're going to get everything from that point on. And I think that is applicable kind of here because, they have our deepest, darkest secrets, but we actually had to have fun conversation around it. And this was on the personal side and on the business side. And so, we're very comfortable working with them on future projects. And we're also pretty well understanding as to what those potential projects might be. And I think that's an important part of it too, is we know now what they'd be a good fit to help us with in the future.
Yeah, and I'll say, specifically a couple of things. For example, we accelerated by a whole year, bringing in a GM, right? Understanding that after going through this engagement, like we got to get some help in here and get out of the day-to-day stuff so that we can then work on these things. So, we have a very different and more fine-tuned outlook on our business. We know the things that we need to focus on to create value of our business. And at the end of the day, now that we don't have this 5-year, pressure that Adam put on me by moving his family to Nashville. You know, we're going to get this business to a place where we could just push the go button every day and, you know, get all this revenue coming in and, you know, and either do other things. Adam's 40 years old. He's got way more runway and opportunity, entrepreneurial opportunities in his horizon than I do. And, you know, I'm looking forward to some retirement. So we feel a lot more comfortable that both of those paths are, you know, much better supported with, you know, the things that we know we have to do in front of us, which, you know, probably another 2-3 years worth of work to get everything where we want it to be.
Paul, did we answer your question or did you still have a question?
He wants to know if I'm a spy.
That was one of the questions. I had a completely different question that didn't rise to the merit of the quality of the question that the women in the office asked. But I do have a question, Melissa, for you and for Jeff, and that is, you know, here Lloyd and Adam's business is a franchise. And do you look at those type of businesses differently than if it were a business that they created themselves? Because they have a different set of support mechanism built in. And so I find that that's an interesting avenue to maybe explore for just a moment.
Melissa, you take this from a valuation perspective and then.
Well, so yes and no. I mean, yes, there is a whole set of, you know, procedures and they have support at a national level and they've been able to grow their territory and all that. So those are all things that are very, very positive. And so, yes, we do take a look at that. But then there are other things that just because they have all that doesn't mean that they're utilizing it, doesn't mean that they're utilizing it in the best way. And so there's still a lot of help that they need to do. And so there's a lot that we can do. So I would say the answer is yes and no.
Yeah, and I will add to that. So because we only had an hour, like we didn't really get deep into some of the conversations that we had through all these questions. And the concept of franchisee versus franchisor came up in a variety and a myriad of questions and conversations, specifically about, and Lloyd alluded to, the CRM system, which as a franchisee, the company has no control over what's being produced from a software development perspective. And there are some pitfalls there that Adam and Lloyd as franchisee and a very respected franchisee within the Budget Blinds community. So Lloyd mentioned that they were Franchise of the Year, which is a fabulous honor. They are one of the largest franchises within them, and they're very well respected. But there are some pitfalls to it from a CRM perspective, from a branding. And that whole concept, and we had conversations, I would say for about an hour, half an hour, about just the word budget blinds and the word budget versus the branding and the marketing that is coming through from corporate and how that affected their territory. We also talked a little bit about on a future, and this is still out there, is what happens at the time of transition. You know, there's legal documents. Does the franchisor have right of first refusal? How does it work? Does it have to go back to them? You know, so there's a lot to talk about here in terms of franchisees. And yes, we had those conversations. Unfortunately, we didn't get into too much of that today here, but yes.
Hey, Paul, I'll add real quick that there's 900 owners across 1,400 territories for Budget Blinds, right? And our franchisor does a great job at putting in vendor alliances and marketing help. And I mean, amazing. We were also Supercuts owners, and the franchisor for Supercuts is 180 out from our Budget Blinds franchisor in terms of support and such. I think from a value business perspective, one of the things that I think we do really well, and we know this because we can see and compare and contrast ourselves against other franchisees that are not doing well, is how much they've, drinking the Kool-Aid from the franchisor, for example. I mean, they give you an operations, that's what franchising is, right? They've already cracked the code on what it takes to be a successful franchisee. As long as you follow the recipe book, you're in great shape and you're going to do well. So, we pride ourselves in, following all of everything the franchisor gives us we take it and we consume it, we'll bake it our own, of course. So, I think a big distinction between, from a value perspective, from a franchisee is how well are they following, the recipe book, their operations manual, and taking advantage of all the services and assets that the franchisor is making available. And, and again, I 100% attribute, aside from mine and Adam's brilliance as businessmen, I 100% attribute a lot of our success to just being a good franchisee and faithfully, executing all of those things.
I did notice that behind Adam was a field operations manual, but if I look closely at it, it just looked like the binder, that there was no paper inside of it though.
It's actually a digital screen.
No.
It's actually my wife.
Okay, so I'm gonna stop us here. I want to thank Adam and Lloyd very, very much, and Jeff, for coming and talking to us today. Thank you, thank you, thank you. I hope everybody enjoyed this. I apologize that we went over. We went over by 15 minutes, and I apologize for that. But I thought that the conversation, I was getting a lot of questions here, and I thought the conversation was good, and I wanted everybody to hear the answers. This was not meant to be about our process. This is the exit planning value acceleration methodology. This is what every, certified exit planning advisors are doing with their clients. And so we want to make sure that as you're doing this with your clients, that you understand how to proceed with your clients and what's going to make you be very incredibly valuable, and what works and what doesn't work. So we hope that by sharing a little bit, and thank you, Adam, and thank you, Lloyd, for being willing to be open and share, your responses with everybody, because sometimes business owners don't want to do that. And so just getting your thoughts and your opinions of how it went for you and what your thoughts are and all that, I think that helps everybody to be able to do this. Hopefully you can take this back and do this with your clients, and it'll be even better. And you can be very, very productive with your clients. So I want to thank Adam. I want to thank Lloyd very, very much. Jeff, I want to thank you from the bottom of my heart. Thank you all for coming. I hope you found this to be enlightening and valuable, and you'll take it back to all of your clients and to your colleagues, and share this with them, and figure out how you guys in your firms want to do this for your clients. The other thing is, we are going to go and we're going to open up. We won't have, you can network in the room for as long as you want, and I hope that you will. On Zoom, we're going to open it up, and we'll have a 15-minute session so that we can get to know each other. Adam and Lloyd, I don't know if you have the time to stay. If you'd like to stay and network a little bit. I know people will have questions for you. Jeff, same with you, but you don't have to, but we'd love it. And thank you very much. We will be back here next month on, I believe it's May 24th. I don't have my paper right in front of me. And we will be doing a group, a case study. So Joel Berman and Channing Hamlet will be leading us in that. And I forgot to do this at the beginning. I'll just do this at the end. I'm sorry, I apologize. But we do have a new host. We're still at the Capital Group, but our new host at the Capital Group is Yelena Vayner. Yelena, would you just take a moment and introduce yourself and the Capital Group to everybody? And then we'll move into the meetups.
Sure, thank you. Save the best for last. I'm kidding. No, just wanted to say hello. Thank you for coming. I've known Melissa for many, many years. And she reached out as John's no longer with Capital and asked me if I would do the honor of hosting this group. And so I certainly appreciate the opportunity to do that. But I'm a private wealth advisor at Capital Group Private Client Services. I've been in the industry for over 20 years, and I look forward to getting to know you. And right here also, you should know Jeff Ruderman is also a colleague of mine with Capital Group, and welcome.
Is he there?
Yes, he is. Jeff's right here.
Right
Hi,
here.
Jeff. Okay. Thank you very much. We're so glad that you're on board.